Look, I need you to pay very close attention to what I'm about to share with you, because what's happening in the gold market right now is something I haven't seen in my entire career, and I've been watching these markets for over 2 decades. 3 days ago, something extraordinary happened that barely made the mainstream financial news. The World Gold Council released data showing that central banks purchased more gold in the first quarter of this year than in any comparable period since 1950. Let that sink in for a moment. We're talking about the people who control the printing presses, the ones who create currency out of thin air, and they're dumping that currency to buy physical gold at a pace we haven't witnessed in 75 years. But here's what really keeps me up at night. It's not just that they're buying gold, it's who's buying it and why they're being so aggressive about it. China's central bank has reported gold purchases for 18 consecutive months. Poland just announced they're accelerating their accumulation program. Singapore, India, Turkey, the list goes on. These aren't random countries making random decisions. These are strategic moves by nations that see something coming that most people are completely blind to. Now you might be thinking, okay, central banks are buying gold. They've always bought gold. What's the big deal? And that's exactly the response they're counting on. Because while everyone's distracted by the stock market hitting new highs and the talking heads on television telling you everything is fine, there's a structural shift happening in the global monetary system that's going to catch 99% of people completely off guard. Let me take you back to a moment in history that's about to repeat itself. It's August 15th, 1971. President Nixon is on television, and he's about to make an announcement that will change the world forever. He's closing the gold window. He's telling the world that the United States will no longer convert dollars into gold at the fixed rate of $35 per ounce. The Bretton Woods system, the monetary framework that had governed global finance since World War II, is dead. Now here's what's fascinating. In the months leading up to that announcement, foreign central banks had been draining U.S. gold reserves at an alarming rate. France alone had converted hundreds of millions of dollars into gold. They saw the writing on the wall. They understood that the United States had printed far more dollars than it had gold to back them up, and they were getting out while they still could. The smart money knew what was coming. And in the decade that followed Nixon's announcement, gold went from $35 an ounce to over $800 an ounce. That's not a 20% gain or a 50% gain. That's a 2,000% increase. People who understood what was happening and positioned themselves accordingly didn't just preserve their wealth. They multiplied it by 20 times or more. Fast forward to today, and we're seeing the exact same pattern, except this time it's on steroids. The difference is that in 1971, we were talking about one country breaking its promise to back its currency with gold. Today, we're watching the entire global reserve currency system begin to fracture. The dollar's dominance, which has been the foundation of global trade and finance for over 50 years, is being actively challenged by a coalition of countries that represent more than half of the world's population. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been joined by dozens of other countries exploring alternatives to dollar-based trade. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting yuan for oil sales. Think about that. For 50 years, if you wanted to buy oil, you needed dollars. That created automatic demand for U.S. currency and allowed America to export its inflation to the rest of the world. That system is crumbling right before our eyes. And what are these countries doing as they reduce their dollar exposure? They're buying gold, massive amounts of gold. But here's where it gets really interesting. The official numbers we see from central banks, as staggering as they are, don't tell the whole story. China, for example, reports its gold reserves monthly, but multiple analysts and industry insiders believe China's actual gold holdings are significantly higher than what they officially disclose. Why would they underreport? Because if the world knew the true extent of their accumulation, it would trigger the very gold rush they're trying to position themselves ahead of. Let me share something with you that most people don't understand about how the gold market actually works. When you hear that gold is trading at $2,700 an ounce, or whatever the current price is, that's the paper price. That's the price of gold futures contracts, derivatives, and ETFs that represent claims on gold, but aren't actually physical metal. The paper gold market is estimated to be anywhere from 100 to 200 times larger than the physical gold market. That means for every ounce of actual gold that exists, there are 100 to 200 paper claims on that same ounce. Now, as long as everyone's happy trading paper and nobody asks for physical delivery, the system works fine. But what happens when the music stops? What happens when a critical mass of investors and institutions decide they want the real thing instead of a promise? We've already seen glimpses of this. In March of 2020, during the COVID panic, the spread between paper gold and physical gold blew out to unprecedented levels. People were paying $50 to $100 per ounce over spot price just to get their hands on physical metal. Dealers were completely sold out. Mints couldn't keep up with demand. That was a preview, a stress test, and the system nearly broke. Now imagine what happens when it's not just retail investors panicking, but sovereign nations, pension funds, and institutional players all trying to convert their paper claims into physical metal at the same time. The word for that is squeeze. And when a squeeze happens in a market as relatively small as physical gold, the price doesn't go up 20 or 30%. It goes parabolic. Here's something else that's not being talked about nearly enough. Gold mining production has been essentially flat for the past decade. We're not discovering major new deposits. The easy gold has been found and mined. The ore grades at existing mines are declining, meaning they have to process more rock to get the same amount of gold. Production costs are rising due to energy prices, labor costs, and increasingly stringent environmental regulations. Meanwhile, demand is exploding. It's basic economics. When supply is constrained and demand is surging, price has only one direction to go. But let's talk about something that hits closer to home for many of you watching this. Your retirement accounts, your 401k, your IRA. For most people, these accounts are heavily weighted towards stocks and bonds. Maybe you've got 60% stocks, 40% bonds, or some variation of that traditional allocation. And for decades, that worked reasonably well. But we're not in a normal environment anymore. The stock market is trading at valuations that historically have preceded major corrections. The Shiller P/E ratio, which looks at price relative to 10-year average earnings, is in the top 5% of all readings going back to 1871. The only times it's been higher were 1929, right before the Great Depression, and 1999, right before the dot-com crash. Meanwhile, bonds, which are supposed to be the safe part of your portfolio, are facing their own crisis. With inflation running hot and interest rates volatile, bond values have been getting hammered. So where does that leave you? If stocks are overvalued and bonds are struggling, what's the alternative? This is where gold comes in. And this is where I want to mention something practical. If you're sitting on $100,000 or more in retirement accounts, there's a strategy you should know about. Gold IRAs allow you to hold physical precious metals inside your retirement account without triggering taxes or penalties. I put together a free guide that explains exactly how this works, what the rules are, and how to evaluate if it makes sense for your situation. You'll find that in the description below. It's worth looking at, especially given what I'm about to show you about where gold prices are headed. Now back to the bigger picture. Let's talk about what happens when this powder keg ignites. We've established that central banks are buying at record levels. We've established that the paper gold market is massively leveraged. We've established that physical supply is constrained while demand is surging. We've established that the dollar's reserve status is being challenged. All of these are individual pressure points, but they're not happening in isolation. They're all happening simultaneously, and they're all reinforcing each other. When gold starts to move, it creates a self-reinforcing cycle. As the price rises, it attracts attention. That attention brings in new buyers. Those new buyers push the price higher. That higher price generates more attention and more buyers. It's a feedback loop. And in a market as relatively small as gold, where the entire above-ground supply is worth less than the market cap of Apple, it doesn't take much capital to move the price dramatically. Let me give you a specific example of how fast this can happen. In 2011, gold was trading around $1,500 an ounce in August. By September, just 1 month later, it had hit $1,900. That's a 26% move in 30 days. But here's what's crucial. That wasn't the beginning of gold's bull run. Gold had already been rising for a decade. It had gone from $250 in 2001 to $1,500 in 2011. That final surge to $1,900 was the blow-off top, the moment when everyone who had been sitting on the sidelines finally capitulated and rushed in. We're not at that blow-off top moment yet, not even close. Gold has been consolidating for over a decade since that 2011 peak. It's been building energy, coiling like a spring. And all the fundamental drivers that pushed gold higher in the 2000s are not only still present, they're significantly more intense. Government debt is exponentially higher. Money printing has reached levels that would have been unimaginable 15 years ago. Geopolitical tensions are at their highest point since the Cold War. And now we have the added catalyst of de-dollarization, which wasn't even on the radar in 2011. Think about the psychology of what's happening. For the past decade, gold has been boring. It's been range-bound. the financial media has largely ignored it in favor of cryptocurrencies, tech stocks, and whatever the hot trade of the moment happens to be. That's actually perfect, because the best time to position yourself in any asset is when nobody's paying attention, when it's out of favor, when it's boring. By the time everyone's talking about it, by the time it's on the cover of magazines, you're late. Right now, we're in that sweet spot where the fundamentals are screaming that gold should be significantly higher, but sentiment hasn't caught up yet. The general public isn't paying attention. Your neighbor isn't talking about gold at barbecues. That's your signal. That's your opportunity. Because once this moves, once it captures the public imagination, you won't be able to get in at these prices. Let me paint you a picture of what the next phase looks like. We're going to see gold break through $3,000 an ounce. That's going to be a psychological barrier, a round number that gets attention. Once it breaks through, there's very little resistance until 3,500. From there, we're looking at 4,000, then 5,000. These aren't wild predictions. These are conservative targets based on historical patterns, monetary expansion, and the structural changes happening in the global financial system. But here's what most people miss. The real gains aren't going to be in gold itself. Gold is the foundation, the anchor, the safe haven. The explosive moves are going to be in gold mining stocks. When gold rises, mining companies don't just benefit proportionally. They benefit exponentially, because their costs are relatively fixed while the value of what they're pulling out of the ground is skyrocketing. A 20% move in gold can translate to a 100% move in a well-positioned mining stock. A 50% move in gold can turn into a 300 or 400% gain in the miners. And we're already seeing the early signs of this. The major gold mining ETFs have been outperforming gold itself over the past 6 months. That's telling you that smart money is positioning in the companies that will benefit most from higher gold prices. They're not waiting for confirmation. They're not waiting for gold to hit 3,000 or 4,000. They're buying now, while valuations are still reasonable, while the crowd is still distracted. Now, I want to address something that skeptics always bring up. They say, gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. And they're right. Gold doesn't pay dividends. But you know what else doesn't pay dividends? The cash sitting in your bank account. In fact, that cash is guaranteed to lose purchasing power every single year due to inflation. At least gold maintains its purchasing power over time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same about a dollar? The purpose of gold isn't to make you rich. The purpose of gold is to preserve wealth across time and protect against monetary chaos. But here's the beautiful thing. In times of monetary chaos, which is exactly what we're entering, gold doesn't just preserve wealth. It dramatically increases wealth relative to everything else. Because while paper currencies are being debased and financial assets are being repriced, gold maintains its intrinsic value. It's not that gold is going up. It's that everything else is going down relative to gold. Let me share a story that illustrates this perfectly. In Weimar Germany in the early 1920s, hyperinflation destroyed the German mark. People were using wheelbarrows full of cash to buy a loaf of bread. Life savings were wiped out overnight. But there were people who survived that chaos with their wealth intact. They were the ones who had converted their marks into gold before the collapse. While their neighbors were destitute, they were able to buy property, businesses, and assets for pennies on the dollar, or in this case, pennies on the mark. They didn't just survive, they thrived, because they understood that in a monetary crisis, the only real money is gold. We're not in Weimar Germany. I'm not predicting hyperinflation tomorrow, but I am telling you that the conditions are being set for a significant monetary reset. The debt levels are unsustainable. The money printing is unsustainable. The geopolitical tensions are unsustainable. Something has to give. And when it does, the people who are positioned in real assets, particularly gold, are going to be the ones who come out ahead. Here's another angle that's not getting enough attention. The younger generation, millennials and Gen Z, are starting to wake up to the fact that the traditional path to wealth building is broken. They can't afford houses. They're drowning in student debt. They've watched their parents' 401ks get decimated twice in the past 20 years, first in 2008 and then in 2020. They're looking for alternatives. And while many of them have gravitated toward cryptocurrencies, there's a growing recognition that crypto is volatile, speculative, and unproven over long time horizons. Gold, on the other hand, has been money for 5,000 years. It's survived every empire, every currency, every financial system. That's starting to resonate. We're seeing record inflows into gold ETFs from younger investors. We're seeing increased interest in physical gold ownership. This is a demographic shift that's just beginning. As more young people realize that the system is rigged against them, that inflation is stealing their purchasing power, that their dollars are worth less every year, they're going to seek alternatives. And gold is the most obvious, most proven alternative in human history. Now let's talk about timing, because that's what everyone wants to know. When is this going to happen? When should I get in? And the honest answer is that nobody can predict exact timing. Markets don't move on our schedule. But what I can tell you is that all the pieces are in place. The fundamentals are aligned. The technical setup is bullish. The sentiment is still relatively subdued, which means we're not in a bubble. And the catalysts are multiplying by the day. Every time there's a banking crisis, gold spikes. Every time there's a geopolitical flare-up, gold spikes. Every time inflation data comes in hot, gold spikes. And we're in an environment where these catalysts are becoming more frequent, not less. The banking system is more fragile than it appears. We saw that with Silicon Valley Bank and the regional banking crisis. That was contained for now, but the underlying issues haven't been resolved. They've just been papered over with more liquidity, more bailouts, more money printing, which of course is bullish for gold. The geopolitical situation is deteriorating. The conflict in Ukraine is ongoing with no resolution in sight. Tensions between the US and China are escalating. The Middle East is a powder keg. Any one of these situations could explode into a broader crisis that sends investors fleeing to safe havens. And the ultimate safe haven, the asset that has preserved wealth through every crisis in human history, is gold. Here's what I want you to understand. This isn't about trying to time the perfect entry point. This isn't about waiting for a pullback or hoping to buy at the absolute bottom. By the time it's obvious to everyone that gold is in a major bull market, you'll have missed the best gains. The time to position yourself is when it's not obvious, when you have to think independently, when you have to go against the crowd. Right now, the crowd is chasing artificial intelligence stocks. They're speculating in meme coins. They're convinced that the Federal Reserve has everything under control and that we can print unlimited money without consequences. That's the consensus view. And the consensus view is almost always wrong at major turning points. The people who make life-changing wealth are the ones who see what's coming before everyone else and have the courage to act on that conviction. I've been in this business long enough to recognize when we're at one of those turning points, and I'm telling you with absolute conviction that we are there right now with gold. Everything I've studied, everything I've analyzed, every indicator I follow is pointing in the same direction. We are on the cusp of a major move higher in gold prices. Not a 10 or 20% move, a structural, multi-year bull market that will take gold to levels that most people currently think are impossible. The question isn't whether gold is going higher. The question is whether you're going to be positioned for it when it happens. Because once this train leaves the station, it's not coming back for you. You'll be watching from the sidelines as gold blows through $3,000, $4,000, $5,000 an ounce, wishing you had acted when you had the chance. So what do? First, educate yourself. Understand why gold matters. Understand the monetary system and why it's failing. Understand the historical precedents. Second, determine what percentage of your portfolio should be in gold and precious metals. For most people, that's somewhere between 10 and 20%, though some advisors recommend even higher allocations given current conditions. Third, decide whether you want physical gold, gold ETFs, mining stocks, or some combination. Each has its advantages and disadvantages. And fourth, take action. Don't wait for the perfect moment. Don't wait for confirmation. By the time everyone agrees with you, the opportunity will be gone. The people who are going to profit from what's coming are the ones who act now, while gold is still under $3,000, while mining stocks are still reasonably valued, while the crowd is still distracted. They're the ones who will look back 5 years from now and realize that this was the opportunity of a lifetime. Don't let that opportunity pass you by. The signs are all there. The writing is on the wall. Gold prices are poised to explode. The only question is whether you're going to be ready when it happens.